what I want to go over is what implied volatility is and how important it is to understand this and how it affects your trades. Because this can mean from you going from $1,300 to $300 in the matter of a day because of one simple mistake. Implied volatility is the metric that captures the market's view of the likelihood of changes in a given security's price. What this means is as implied volatility goes up, we become uncertain of where the market is heading. We don't know if it's going to continue to go down. We don't know if it's going to continue to go up. We don't know if it's going to go sideways for the rest of the year. Nobody knows. And that's why implied volatility goes up, because the securities become more expensive to obtain, which would include the options, and we become uncertain. Implied volatility is in connection with Vega. We look at Vega's definition. Vega is a measurement of an option's price sensitivity to changes in the volatility of the underlying asset. Vega represents the amount that an options contract price changes in reaction to a 1% change in the IV of the underlying asset. We're going to look at this right now. Vega is right here. It's at 0.0015. So meaning if this option or the stock was to decrease by 1%, we would lose 0.0015 of value in this option, which wouldn't even mean that this would drop to 13 or 12 cents. However, we need to understand that that represents only 1%. This current option is having a implied volatility of 253%, because recently it jumped up $1 in a day, meaning it went from $2.24 of value to $3.24 in value. So let's say tomorrow it was to jump up another dollar. Well, that means that this stock is now going up, and we kind of understand where it's heading. So, with that being said, we are no longer uncertain of where the stock is heading. We know it's going up because it's starting a trend. Meaning, we don't need this 253% anymore. We're pretty certain that it's going to go up. So the implied volatility is going to probably drop down to 50%. That is a 203% implied volatility drop. Now, you're telling me probably, well, if it jumped up $1 tomorrow, I'm going to gain a delta of 20 cents. For every $1 increase, delta represents that. So 20 cents for every $1 increase would mean that this goes from 13 cents to 33 cents. But if we calculate a 203% implied volatility decrease, times that by 0.0015, that would be a 0.3 cent decrease in value if this implied volatility was to decrease. Because I'm sure it's not going to continue to go higher. It may go to 300%. It's possible, but it's very unlikely because we kind of have an understanding of where this stock is going now. So 203% times that by 0.0015 leaves you with 30 cents of a decrease. Now, we're going to do all the calculations now. The stock went up $1, which means the delta is going to give us 20 cents added to this 13 cent it already is. We are now at 33 cents. But since the market's going to open tomorrow, then the theta is going to drop by 1 cent, almost 2 cents. So let's say we take that 33 cents and we drop it down to 31 cents because we know what it's going to turn out to tomorrow. Since today's already done, it's like 9:58 right now. So it's going to drop from 33 cents now to 31 cents. Now let's go ahead and add in the Vega of 30 cents subtracted from that 31 cents. Just because it increased tomorrow by $1, your new value is going to be 1 cent that this contract is worth. This is why it's so important to understand what implied volatility is and why people are afraid to trade right now, because they understand the risk that are involved. You know, yes, you could buy closer to the money, but look at this. This is the next option I could buy. I could buy in the money if I wanted to. Sure. But if I was to buy out of the money, look at how risky this is. This is March 20th. It is currently March, I think, 10th. It is currently March 10th, meaning I have 10 days to still trade. And because it jumped by $1 tomorrow, I still have 10 days worth of this option to increase even more, but it's not really going to do anything for me because this is valued at $3.24. So the likelihood of another dollar, $3 in total in 3 days is pretty unlikely. So I hope you guys got a good understanding of what implied volatility is and what it looks like and how it can affect and how you can find it on Robinhood. Because you need to study this whenever it comes to trading options. If you do not, it could cost you your whole portfolio. I hope you guys enjoyed. If you guys have any other questions or any ideas for any future videos I could be, making or continuing to do, please let me know. I would love to do them for you guys. It excites me to be able to teach people and warn people about the risk that could come with trading. And again, if you guys have any questions, if you like the video, please make sure you drop a like. Feel free to share it and subscribe. I hope you guys have a great night.